You're listening to 59.5 Retirement Chat Radio. Powered by My Retirement Exit. Now here's your host, Jenny Jones.
Hello, caller. Welcome to Retirement Chat Radio. Let's start with your name and where you're calling from.
Hello, this is Michelle, and I'm calling from Houston, Texas.
Hello, Michelle from Houston, Texas. Okay, what is the purpose of your call today?
Thank you so much for taking my call. I am curious to know how or if it is possible for those of us who have fallen behind in saving for retirement or have cashed out 401k plans or other types of retirements, if it is possible to catch up in those later years of our life.
Okay, that's a good question, Michelle. Let me see, falling behind and or cashed out to see if it is possible to catch up in those later years. Okay, let me start with my disclaimer. Please do not take my responses as actual advice, as I will only speak in hypotheticals. Please always consult with your own professional advisor, as they are the only ones that know your entire situation. Okay, I think it's rather ironic that you would be asking this question. In fact, this is the very thought in the new legislation that was just passed. It's called H.R. 2954, or the Securing a Strong Retirement Act of 2022. In short, well, that's commonly referred to as Secure 2.0. Right, you see how they put that secure, so they're trying to look out for retirees, but there's a catch-22 to that, and I'll explain a little bit later. But I think even Congress is realizing that this retirement game is changing right before our eyes with this new list of provisions and changes. They have a whole ton of lists and changes, and you can probably look it up if you do just a regular Google search on H.R. 2954. Okay, so first of all, one good change is the limits to contributions have been increased up from $20,500 a year to $22,500, or an increase of about $2,000. The limit on an annual contributions increased to $6,500 from $6,000. Also, there were a whole list of other contribution limits raised as well. Sure, we can get excited about this, but also keep in mind that the tax brackets also changed slightly. So while in some cases it may look good that the limits increased on the surface, they really adjusted with the new tax bracket changes, which was about $1,500 to $2,000 per tax bracket. So, it looks like they're helping you out on one side, but again, they're adjusting the tax brackets as well. So again, that's another story for another day. What I would also do in their case is I would look at the qualitative factors instead of just the quantitative numbers. And what I mean by that is, what do you envision retirement looking like, right? When I say qualitative numbers, it's what do you think retirement will be? What is your quality of life when it comes to catch up? People saying, hey, I need to catch up, and what are the catch up provisions? You really need to just position yourself to try to make sure that the quality of life will not change. You probably can't get there on a quantitative factors, and you may require downsizing or just adjusting as well. So that's what I mean by quality or the quantitative. Instead of just qualitative, it's the quantitative as well. So your qualitative of life, right? So I would also tell them to make sure that they get with a good planner to make sure that they have calculated all their income and obligations correctly. This is very important. And as always, seek out a financial professional who knows everything about you before giving you advice. They do this by taking a financial intake form where they know where all of your assets are. This gives them a full picture so that their advice that they provide will be sound. Actually, I'm writing a book and creating a major self-study course that will address this in more detail. Do not have to sign up for our mailing list on our website to ensure you do not miss that. That's coming out real soon, probably in the next 60 to 90 days. It's going to be comprehensive, and it may be able to shed some light and help you out on that. Hey, thanks for your call, Michelle. Okay, next caller. Welcome to Retirement Chat. What's your name and where are you calling from?
And I am calling from Sacramento, California.
Hello, RJ from Sacramento. Now, finally, someone close to me. Okay, so what is the purpose of your call today?
My question is, can a pre-tax 401k Roth make money besides the employer match, can it make money in this economy? Thank you.
Okay, that's a good question, RJ. Let's see here. Pre-tax 401k Roth, make money in this economy. Okay, let me start with my disclaimer. Please do not take my responses as actual advice, as I will only speak in hypotheticals. Please always consult with your own professional advisor, as they are the only ones that know your entire situation. Okay, so pre-tax 401k Roth. Well, that's two things in one. So a pre-tax is just inside of a pre-tax component, but it's a 401k nonetheless. Roth, meaning that they've already taken the money out. So it's a Roth that's encompassed in a 401k. So it is in that plan. All right. So had to break that down, right? So nonetheless, let's see, to answer that question for a person that came into my office, hypothetically, I would ask a few follow-up questions to learn more about what they would currently have in their current portfolio holdings or positions. That's very important to know what they currently have to even answer this question. I love one thing that they mentioned, and it would have jumped out at me right away. They said the two magic words that every planner wants to hear: employer match. Okay, I learned 20 plus years ago, whenever an employee matches, you always take the free money. If a random person came up to you on the street and held out their hand and said, "I will give you $1 for every dollar you put inside my hand." Okay, if a person came up to you and did that, then would you try to put as much money in their hand as possible? Sure you would. Of course you would do that. This is what is happening when employer matches. What if they give you $1, they give you another $1 back, you put another $1 in. And normally it's up to, sometimes they'll match 4%, 5%, sometimes 12%, they'll match up for you. So that's very important, and it needs to be looked at anytime you want to take the free money if the employer is matching. Okay, so I just got chills because too many employees still match, not too many, even match nowadays. Okay, so second thing I would say to them is they would determine if they could make money in this economy is my rule, right? You know, what you want to know is, can you make money pretty much in this economy? You can make money in any market with good underlying portfolio holdings or investments. Most people think you just need to have a good market that is always going up to make money. That is only partially true. Having a master's degree in finance did not teach me this. In fact, being in investments for over 20 plus years didn't even come close to teaching me what I'm about to share with you right now. My mom taught me this when we used to go to Kmart as kids. We used to go and my mom used to say, all right. So she said, hey, listen, she said, always buy things on sale. She told me, my brother, my sister, she says, son, you always buy things on sale. So when you see the blue light on over here, meet me over here. Let's meet over at the clothing aisle, clothing rack. So we'd rush over there and see what's on sale immediately. She would say, buy winter clothes in the summer and buy summer clothes in the winter. She would always say, you buy things on sale. What am I trying to say to you? If you have a good investment initially is when you bought it, it's a good investment. It theoretically have the makings to be an even better investment in a down market. Why? Because it's on sale from its normal suggested retail price. That means you're buying more of it when it's at a less price. If the average resale price or the average price of a mutual fund holding that you're purchasing is $20, let's just use that for a hypothetical example, and the market drops, and now that same value of that mutual fund is $15. Now you're buying it at $15 when the normal average price is $20. So when it comes back up to $20, you've already $5 up already per share that you purchase. So you're buying it on sale, right? And so the key word here is a good investment. So this is what I would tell them. This is the hypothetical person that I would tell that came into my office. But in retirement plans, in most cases, you will have built-in protection based on the custodian selection. The 401k or the retirement plan custodian, they normally don't allow you to buy, or it's very rare that you have individual stocks in there where you can actually hurt yourself in retirement plans. There's exceptions to this rule, but this is normally the case. You find it very hard that you're going to actually hurt yourself. In fact, if you study even harder, you'll find that if you just got into cash funds or just bond funds all the way, you would be losing money in a long period of time, because by the time the custodian got their fees and inflation kicked in, you would actually be losing, right? Why? Because retirement is a long game, and economic cycles will happen. It will contract and it will expand. But if you have good investments, they are usually set up for the reinvestment back into that same fund, even in bad times, or what is commonly known as a bear market. So you are essentially dollar cost averaging back into shares that are on sale in a bear market and positions themselves into a bull market. I spoke about this more in my second book that is available on Amazon. I'll put a link in the description below, and you can take a look at that, and I actually talk about that a little bit more, trying to measure your contractions and expansions going through the economic cycles. As always, seek out a financial professional who knows everything about you before giving you advice. They do this by taking a financial intake form where they know where all of your assets are. This gives them a full picture so they'll be able to provide you advice, very sound advice. Please like and subscribe so you don't miss another episode, and look for any descriptions of any links that I talked about or references in this segment. You guys take care. Thanks again, RJ, for your call. Next caller.